Hi everyone, and welcome to Coffee with Eddie. This month we're speaking with Tom Freidel, the owner of Padgett Business Services. And in episode 92, we're talking about the top 3 things you need to do to prepare your taxes for this year. Okay, Tom, it's my favorite time of year. Not Christmas, not Thanksgiving, tax filing season. We're getting ready. I know that I have a lot to do. What are the top 3 things people need to do to prepare for tax filing season this April?
It's a great question. I mean, typically I tell people start with what you had last year, right?
Okay.
Make sure that you're getting all of the documents, your W-2s, your 1099s, 1098s. If you look at what you had last year, that's going to help you get prepared for this year.
Okay.
Second thing is deductions, right? Really sit down and think about what did I do this year that could be deductible? What charitable contributions did I make? If I have a business, do I have a good summary of my income and expenses? Because the number one way to reduce your taxes is to not forget your expenses, things that are deductible. Third thing is start thinking about 2020, right? As we think about 2020, what's our income going to be? Do we need to do a tax projection? Are there tax estimates that need to get paid? So that's kind of the top 3 things, I think.
So when you talk about deductions, political contributions, are those deductible?
No.
Okay.
No, not on any level anymore.
Not on any level.
Right.
Now, what about home improvements?
Home improvements, they're not really deductible per se. There's an exclusion for selling your home. The first $250,000 or $500,000 a gain on selling your home is excluded from income today. So any improvements you're making to the house, unless you're looking at a gain of that value,
in there.
Yeah, you're not going to worry about. Certainly, if you have a rental property or an investment property, those improvements, absolutely, you'd want to make sure that you're tracking and picking those up because those would be deductible against that income.
So let's dummy it down for me. When you talk about a gain, the first $250,000, you're talking about what your equity is, what you're walking away with on top of what you paid for the home?
No, you're going to look at what you originally paid for the home, or the original purchase price, plus any of the closing costs, and any of the improvements that you made over the time that you owned it, compared to what you sell it for, less the expenses of selling.
Got it.
So in our market, a $250,000 gain for a single individual, a $500,000 gain for a married couple is pretty unusual to see in the Northwest Ohio market.
So when it comes to tax filing, something that's near and dear to my heart, home deductions. So there's a tax credit that's available for people that have that own a home, an interest deduction. Can you tell me more about that?
Yeah, so you're able to take itemized deductions. You can take state and local income taxes or real estate taxes. You can also deduct your mortgage interest and charitable contributions. Those are the big categories. There's medical expenses as well, but those are the 4 big categories of itemized deductions. So the real estate taxes, the mortgage interest, those are certainly near and dear to your home as a what you do as a realtor. The new standard deduction for a married couple is $24,400. For a single person, it's $12,200. So a lot of people are ending up just taking the standard deduction because their state and local taxes, their mortgage interest, charitable contributions don't exceed those thresholds. But you should definitely still track them because some years you might have contributions that exceed another year that would put you into that category.
So you mentioned something that I had never heard before. You said medical expenses. How is that deductible?
So any post-tax expenses that you pay for qualified medical expenses, it could be premiums if they're not pre-tax, it could be any co-pays that you pay, prescriptions that you pay. They do have to exceed 7.5% of your adjusted gross income before you can deduct them, but you would certainly be able to track them. And sometimes, while you might not be able to get any benefit on the federal return, you can certainly get a benefit on the state return. So it's always good to report them.
So one final note, how does health insurance and how does that affect us as far as our taxes are concerned when filing?
Well, most people have their health insurance premiums deducted from their paychecks pre-tax. So it's already coming out of the pay before we calculate taxes. So there's really nothing to do there. But somebody self-employed like we are, those are deductible expenses on our tax returns that we definitely want to make sure we're not missing that deduction.
Thanks for tuning in to Coffee with Eddie this month. It's been a pleasure having you join us. If you would like to learn more about Padgett Business Services or about real estate, please give me a call, or you can contact me at my email address or on social media. You'll see that information on the screen below.